In the Little Book of Common Sense Investing, John Bogle, the founder of the Vanguard Group, shows us that successful investing is all about common sense. As Warren Buffett said, it is simple, but it is not easy. Hi, welcome to The Holder Investor, and in this video, we will go over the top 5 lessons from the Little Book of Common Sense Investing by John Bogle. Lesson 1. Index Funds. Simple arithmetic suggests, and history confirms, that the winning strategy is to own all of the nation's publicly held businesses at a very low cost. By doing so, you are guaranteed to capture almost the entire return that they generate in the form of dividends and earnings growth. The best way to implement this strategy is indeed simple: buying a fund that holds this market portfolio and holding it forever. Such a fund is called an index fund. The index fund is simply a basket or portfolio that holds many eggs or stocks designed to mimic the overall performance of any financial market or market sector. Classic index funds, by definition, basically represent the entire stock market basket, not just a few scattered eggs. Such funds eliminate the risk of individual stocks, the risk of market sectors, and the risk of manager selection, with only stock market risk remaining. Like, for example, the S&P 500 index contains the 500 bigger publicly held businesses. Lesson 2. Play a winner's game. In the 2005 Berkshire Hathaway annual report, Warren Buffett told a story about the Gottrocks family. A wealthy family named the Gottrocks owned 100% of every stock in the United States. Each year, they reaped the rewards of investing, all the earnings growth that those thousands of corporations generated, and all the dividends that they distributed. Each family member grew wealthier at the same pace, and all was harmonious. Their investment had compounded over the decades, creating enormous wealth, because the Gottrocks family was playing a winner's game. But, after a while, a few fast-talking helpers arrived on the scene, and they persuade some smart Gottrocks cousins that they can earn a larger share than the other relatives. These helpers convince the cousins to sell some of their shares in the companies to other family members and to buy some shares of others from them in return. The helpers handle the transactions, and as brokers, they receive commissions for their services. The ownership is thus rearranged among the family members. To their surprise, however, the family wealth begins to grow at a slower pace. Why? Because some of the return is now consumed by the helpers, and the family's share of the generous pie that U.S. industry banks each year, all those dividends paid, all those earnings reinvested in the business, 100% at the outset, starts to decline, simply because some of the return is now consumed by the helpers. To make matters worse, while the family had always paid taxes on their dividends, some of the members are now also paying taxes on the capital gains they realize from their stock swapping back and forth, further diminishing the family's total wealth. The smart cousins quickly realize that their plan has actually diminished the rate of growth in the family's wealth. They recognize that their foray into stock picking has been a failure and conclude that they need professional assistance, the better to pick the right stocks for themselves. So they hire stock picking experts, more helpers, to gain an advantage. These money managers charge a fee for their services. So when the family appraises its wealth a year later, it finds that its share of the pie has diminished even further. An old uncle advised the family to get rid of all their brokers, get rid of all their money managers, get rid of all their consultants. Then our family will again reap 100% of however large a pie that corporate America bakes for us year after year. They followed the old uncle's wise advice, returning to their original passive but productive strategy, holding all the stocks of corporate America and standing pat. That is exactly what an index fund does. The moral of the story is, for investors as a whole, returns decrease as motion increases. So, to realize the winning returns generated by businesses over the long term, the intelligent investor will minimize to the bare bones the cost of financial intermediation. That's what common sense tells us. That's what indexing is all about. Lesson 3. How most investors turn a winner's game into a loser's game. How much do the costs of financial intermediation matter? Hugely. In fact, the higher costs of equity funds have played the determinative role in explaining why fund managers have lagged the returns of the stock market so consistently for so long. When you think about it, how could it be otherwise? By and large, these managers are smart, well-educated, experienced, knowledgeable, and honest. But they are competing with each other. When one buys a stock, another sells it. There is no net gain to fund shareholders as a group. In fact, they incur a loss equal to the transaction costs they pay to those helpers. Investors pay far too little attention to the costs of investing. Let's assume the stock market generates a total return averaging 8% per year over half a century. Now, let's assume that the costs of the average mutual fund continue at their present rate of at least 2.5% per year. Based on these assumptions, let's look at the returns earned on $10,000 over 50 years. The simple investment in the stock market grows to $469,000, a remarkable illustration of the magic of compounding returns over an investment lifetime. By the end of the long period, the value accumulated in the fund totals just $145,400, an astounding shortfall of $323,600 to the cumulative return earned in the market itself. The investor, who put up 100% of the capital and assumed 100% of the risk, earned only 31% of the market return. The system of financial intermediation, which put up 0% of the capital and assumed 0% of the risk, essentially confiscated 70% of that return. Lesson 4. Profit from the Majesty of Simplicity. If low costs are good, and I don't think a single analyst, academic, or industry expert would disagree that low costs are good, why wouldn't it be logical to focus on the lowest cost funds of all index funds that own the entire stock market? Several index funds carry expense ratios as low as 0.10% or even less, and incur turnover costs that turn out to be zero. Standard & Poor's Corporation now compares index returns with actual returns achieved by active managers in many U.S. market segments, and the results are unmistakable. Over the past 5 years alone, the S&P 500 index has outpaced 67% of large-cap general equity funds, while the S&P Mid-Cap 400 index has outperformed 84% of mid-cap funds, and the S&P Small Cap 600 index has outperformed 79% of all small-cap funds. While it is alleged that indexing doesn't work in markets that are less efficient than the large stocks in the S&P 500, the impressive performance of the small and mid-cap indexes suggest that it works perfectly well. Also, the S&P International Index, world markets less U.S. stocks, outpaced 80% of actively managed international equity funds over the past 5 years. Similarly, the S&P Emerging Markets Index outpaced 88% of emerging market funds. Lesson 5. Reversion to the mean. Yesterday's winners, tomorrow's losers. In selecting mutual funds, most fund investors seem to rely not on sustained performance over the long term, but on exciting performance over the short term. Studies show that 95% of all investor dollars flow to funds rated 4 or 5 stars by Morningstar, the statistical service most broadly used by investors in evaluating fund returns. How successful are fund choices based on the number of stars awarded for such short-term achievements? Not very. According to investment analyst Mark Hulbert, a mutual fund portfolio continuously adjusted to hold only Morningstar's 5-star funds earned an annual return of just 6.9% between 1994 and 2004, nearly 40% below the 11.0% return on the total stock market index. To make matters worse, according to Hulbert, these highly rated funds were assuming even more risk than the market. Average monthly volatility in asset value 16% for the funds compared with 15% for the stock market. The message is clear. Avoid performance chasing based on short-term returns, especially during great bull markets. A mutual fund or active management ETF that is having a good performance in a bull market for a short period of time might not sustain and even lose these gains in the long run. Statistics say they will. To get the compound returns of the stock market, you have to hold your investments at low costs for the long run. However, sometimes it is difficult to do so because of our behavior bias. In the book The Psychology of Money, Morgan Housel shows us how to deal with investments from the psychology point of view. This is very important to succeed in the long run. You can check out the summary of this book in the description below. Please click on the like button and subscribe to receive the next videos. This will help me a lot. Thank you for watching. See you in the next video.